God! So hard to start a small business and manage all my income and my balances. Oh my God.
It sounds like you need a budget. Lucky for you, I'm a budget master.
Budgets are vital to businesses' success because it allows for them to plan and visualize the usage of financial and other resources that they have in their possession, and how they plan to attack specific time periods to create the most success they can, both within their workers and within their financial gains. Some advantages of budgeting include you're able to define goals and objectives, so they're laid out in front of you and you know what to strive for, to achieve. It allows people to think about the future, plan for the future, and foresee anything that might come up, and really set a precedent for how the business will move forward in their production. It's a means of allocating resources, so no or very minimal resources go to waste. It will allow people to uncover potential bottlenecks, stuff that would hinder the business's success or hinder production in any way. But most importantly, it allows businesses to communicate activities or coordinate activities and communicate plans. Being on the same page as a business is essential in its short-term and long-term success, because if upper-level management wants something done one way and lower-level workers aren't producing, or lower-level workers are striving for a different goal, then the business is doomed to fail. Participative budgeting is a way of solving this, where it's prepared with the full cooperation from top to bottom of the whole business. So everyone is on the same goal and everyone's on the same path of creating the best outcome for the business in the given period. People they feel like members of the team when participative budgeting is in play, because everyone plays a part and everyone plays a role in the business's success. It allows for estimates to be more accurate, because maybe some workers know a certain cost, or some upper level management know a certain cost that would change or alter the budget. Motivation is generally higher because setting your own goals kind of allow for interpersonal drive and determination, rather than having to come from an external source. And it doesn't have kind of the executive budget where it's all profits. It comes with expectations of what workers can actually produce. And when considering a budget, the top level of management, they got to be enthusiastic and committed to the goal, because without kind of faith in the company, it's not going to go anywhere, and the budget is all for nothing. To really use a budget effectively, you can't use it to persuade employees. It's got to be kind of a goal that they can work for, and it has to be achievable. Targets are something that can be scary, but they can also be something that drives people and something that motivates people to work their hardest. To get us started in the budget, we will look at sales budget, which is the budgeted sales in units multiplied by the selling price per unit that upper level management sets, which they're selling their product for, and in turn we'll get the total budgeted unit sales. For cash collections, because it's important that we budget how we collect this cash when we sell these units, oftentimes businesses will proportion out when they take in a certain portion of the sales revenue in terms of accounts receivable. So let's say that we sold 100,000 for our total budgeted sales in January, and we're splitting 50-50 with collections for this month and the following month. So it will be 100,000, and then in the collections for January it will be 50,000. 50,000, and then the collections for February will also be 50,000. So that both of those add up together to reach the 100,000 in total budgeted sales. Next, we'll look at the production budget. So we take the budgeted sales in units that we found in the sales budget in which we first began. And then we will add desired ending inventory, which is a proportion of the following month's budgeted sales. So let's say in January we sold 50,000 sales in units, and in February our budgeted sales is 100,000. And the percentage that we're looking for desired ending inventory is 25%. So it would be 50,000, and then desired ending inventory would be 25,000. So that we would add those two together and we would get 75,000. And let's say the beginning inventory we had before all of this started was 30,000. We're going to subtract that in 30,000. So we are left with 45,000 as our required production. So in order to build these units for sale, we need to acquire direct materials that will be used in production. And to calculate this, we'll start with the required production all the way up top, which is 45,000. And then let's say the materials that we'll need per unit is 2. And then the production needs is just that multiplied, because it's the required production times how many materials we need to produce just one unit. So it would be 90,000. Let's say for math's sake that in February the production needs are 200,000, and oftentimes ending inventory will be a proportion of the following month's production needs, so we can plan ahead and produce the units we need for the following month. So let's say it's 30% of 200,000, so that would be 60,000. So we would add those two together, and then we would get the total materials needed, which is 150,000. And then we would subtract the beginning materials that we already have from the previous quarter. Let's say it's 20,000. So the raw materials we need to purchase would be 130,000. And then the cost per pound of that units, or of those raw materials rather, is 0.5. Let's say half of a dollar, 50 cents. So we would get the price of materials we need to buy in January to be $65,000. Similarly to how businesses do cash collections in terms of percentages per month in the following month, they do cash distributions the same way, or cash disbursements. So let's say that our cost of raw materials to be purchased was that 65,000 that we found in the direct materials budget. Let's say we're collecting 70% in the month of January and 30% in the month of February. So we would do 65,000 times 70%, or 0.7. We would get 45,500, and we would then do 65,000 times 30%, or 0.3, to get 19,500 to be paid in the month of February. Now we're going to look at the direct labor budget, so we know how to allocate our workers' time most effectively. So from our production budget and our required production for January, we see that we need 45,000. So let's say that our direct labor time per unit is 0.2. We're going to multiply those two together. So that would be 9,000 in the labor hours required for our desired units of production. And let's say the hourly wage that we are paying these workers is $15 per hour. We'll multiply that 9,000 times the $15 that we're paying them, and then we will get $135,000. So next we're going to look at the manufacturing overhead budget. So first, we're going to start out with the direct labor hours that we have budgeted for January that we found in the direct labor budgets. That would be 9,000 up at the top. And then let's say our variable manufacturing overhead rate is $10 per direct labor hour. So we're going to put that right underneath. So we multiply those two together, and in turn we get $90,000 as our variable manufacturing overhead. Let's say our fixed manufacturing overhead is $20,000. So we'll add those two together and get $110,000 for our total MOH, and then we will subtract the non-cash costs that we've incurred by running this business, and let's say it's $10,000, let's say. So the cash disbursements that we are going to allocate for manufacturing overhead in the month of January would be $100,000. Next, we're going to look at the ending finished goods inventory budget. So we're going to take our direct materials all the way up top, the quantity, which is 2 pounds, times the cost, which is 0.5, so our total is going to be 1. The direct labor underneath that, so it would be 0.2 times the cost of direct labor per hour, which is 15, so that would be 7.5. And then the MOH, so again, the direct labor at 0.2, let's say the cost is 50 and our total for that would be $10. So the unit cost, our budgeted unit cost would be 18.5. Let's say our desired end inventory is 10,000. We're going to multiply that by 18.5, and in turn, we're going to get $185,000 in ending inventory finished goods. And finally, we're going to look at the selling and administration expense budget. So let's say our budgeted sales for January is $10,000. Our variable selling and administration rate is 0.2. We're going to multiply those two together and get $2,000. Our fixed selling and administration is 50,000. So we're going to add those two together and get 52,000. The non-cash selling and administration costs is 12,000. We're going to subtract those. Let's say those are 12,000. We're going to subtract those, get 40,000, and those are the cash disbursements from selling and administration in the month of January.
Wow, thanks, Budget Master.